Hi everyone, let's go over my micro, bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the first scenario where we're looking for a bigger three-wave structure to the downside in a WXY, potentially here a double zigzag, where in wave W we have over here wave A, B, and then a sideways C over here, where inside this wave C we've then been looking for zigzag structures in a 1, 2, 3, 4, 5 ending diagonal, and in an ending diagonal all the waves have to be a zigzag structure, meaning all the waves have to be three-wave structures like this, creating a ending diagonal for then this wave C over here. After wave W, which then by itself is a three-wave structure, we're looking for this wave X over here, which then also has to be a three-wave structure, with a scenario coming up later on how I've counted this as a three-wave move, for then eventually continuation to the downside in then a wave Y. Now this eventually leads to a more bullish scenario because the WXY is a corrective pattern, which is a 3, 3 and then another 3 before then again continuation to the upside. If we look at this scenario over here from the low towards the upside, this is the impulsive and the most bullish scenario, where this is the low after then a three-wave ABC to the downside, low is in, and we're looking for new highs to be made. In this particular scenario, we then have a wave 1 over here that is finished, 1, 2, 3, 4, 5, some sort of a diagonal here as well because of the overlap between 1 and 4, and it gotta say that counting this as an impulse to the upside, just as explained in the previous video, is not very nice. If we look at a regular impulse, 1, 2, 3, 4, 5, where 4 and 1 don't have overlap, that is kind of impossible over here. If we think about a diagonal, then we have wave 1, 2, 3, 4, 5, where all of the waves have to be either a 5, 3, 5, 3, 5 structure, or all of the waves have to be zigzags. Now in this scenario is then a 5, 3, 5, 3, 5 wave structure, creating a bigger diagonal, and then wave 1 is a diagonal by itself, but this wave over here, this little one, is quite difficult to count. This might be a wave 1 where all the waves are three-wave structures, but hey, that is very, very low time frame. I'm on the 50-minute. I prefer not to go to lower time frames usually. And then a double 1, 2, well, that scenario is kind of like invalidated as well. So regarding the bullish, more impulsive scenario, this is currently the move where we then have wave 1 in blue, followed by a three-wave A, a three-wave B, and then an impulsive C to the downside, where the most common target area for C is between the two 1.618s over here, and a rare target for a wave B expanding flat taken from the high to the low of A with a normal Fibonacci tool is the 1.618. Now currently price is finding support on top of the daily over here, and below this daily I don't have a lot of support left because this target box over here has already been hit once, so the support has kind of been taken. So I think that if price is going to lose this daily and starts closing candles here, we can as well look for a move, a bigger move towards the downside, where someone like one of the next support areas on my chart here between 26.2, 26.3, and even lower over here 25.7 to 25.9k. Also, what is interesting is that price went just through the daily. I had a daily over here. It kind of got through, but then what it did is it found resistance over here at the beginning of this little gap. So over here we had a bit of a fair value gap, inefficiency, whatever you like to call it. Price hit that area and then moved towards the downside, which was very nice indeed. If we then go to this more bearish scenario, in this particular scenario, we're looking for a first move, second move, and again, a continuation to the downside, either an ABC or 1, 2, 3. But in this scenario, we're looking for a three-wave structure to the upside and then an ABC. Now, wave A is a 5-wave structure, so it's then the same count as I have over here. Then we have B in again an expanding flat, and you expect a C to the upside. The thing is, however, that time-wise, I prefer for this to be a corrective move, right? Instead of an ABC, I prefer this to be the high because it works a little bit better when we look at time. If we take a trend-based fib time from the high to this low over here and you double click, you can see that this high has been made in between the 1 and the 1.618 trend-based fib extension, which is a very, very popular like time area for a confluence. If we look between waves, a WXY or a 1-2 continuation to the downside or an ABC, this area in general is an interesting area. So preferably you don't actually have an A, B and another C, as then time-wise it's going to be quite long. It's not impossible possible, but it would be nice if this is basically the high. So in this bearish scenario, after a CDO, you expect to move down, and based on the low that we have, and I think price moved down just a little bit further over here, you can see that the daily naked point of control at the high is just around the 1.236, which still is a common target for a wave C. So then you would expect a 5, 3, and now a 5 wave move to the upside, taking this high likely to hit the daily naked point of control, which, by the way, is on top of the 786 Fibonacci taken from the high to the low, as you can see over here. Literally at the exact same price level. If we then look at the final scenario, I like to show you then in this scenario, we're also again looking for a continuation to the downside, where in this scenario, I kind of attempted to count this structure differently. So instead of this being a 5-wave move to the upside, so a 5 and then a correction and potentially a 5, I now have over here a WXY scenario, which means that all of the waves are 3-wave structures. And it is very complex counting. It also involves a lot of lower time frame counting, which is not really something I enjoy. But over here, we then have a wave A and a 1, 2, 3, 4, and then a wave 5, a correction in B, a zigzag, a wave C for then a zigzag in W, another 3-wave structure in X, which is then a flat because over here the high got taken. So then we have an ABC here, followed then by a 3-wave structure for wave Y, which is then also an ABC. So we have a WXY double zigzag, and then we have a continuation to the downside, continuing the trend, basically the very, very local trend, right? Down, sideways, corrective up, and then continuation to the downside, where the invalidation of this particular scenario is the high. So this high over here is important and kind of not the one that you want to see broken if you are bearish. Now, if we then look at the CVD divergences over here, we had bearish CVD divergences, not with the actual high, that's quite a pity, but with this in-between high over here, so the lower high. The bearish CVD divergences started when price was here, continued ranging, and eventually we found another high, and the bearish CVD divergences were still active. We never really got bearish CVD divergences with the high over here. So if I put my cursor on the yellow line and we look to the right side, you can see the horizontal cursor line has not been touched, and the same for the blue top over here has not been touched. However, if we look at the yellow line and the peak over here, it is higher than this little peak in yellow, which is this little high. So we do have bearish CVD divergences, not with the actual high, but with the lower high over here. And the target for those bearish CVD divergence is this low over here. Now, as price is moving down, you also now see bullish CVD divergences. Now, based on statistics, it has to be said that the CVD divergence that is visible first has a higher probability of playing out. However, this bullish CVD divergence at least is with the low over here, but we have very high volume coming down. So what I prefer to see is if I look for price to take this high again, because that's the target of this bullish CVD divergence, what I would prefer to look for is a bit of a move to the upside, create a bit of a range, create a bit of a bounce, a retracement, and then locally bullish CVD divergences. That is for me much more trustworthy than this one over here. So if we then finally look at the probabilities of the different scenarios, then, well, on this time frame, I've said a lot, but of course, I'm kind of in the middle. What I want to see is waiting for a range, observing the CVD. I think based on the price action over here and the difficulty, just like the previous video, of counting an impulse here to the upside, that my feeling gives a higher probability to seeing downside over here, because it is very difficult to count a very like a nice impulsive structure in this range to the upside. And the fact that it's so difficult to count any form of an impulsive structure over here, probabilities are kind of higher, I suppose, for a move to the downside than the upside. But after a move like this in general, I just like to wait for a range, and the range can form over here, and then we get more clarity and look at CVD. The range can form down here, the range can form down here, right? Whenever I see a volume move like this, either you're already short up here, that's nice, you're in profit, manage it well. If you're not, I always like to wait for a range, because a range is what gives us clarity from an Elliott wave point of view. But currently, yeah, probability wise, it's just very difficult to count an impulse, as mentioned in the previous video. So I suppose then probabilities are higher for a move down. But then again, I like to wait for a range and it will give us more clarity. Keep an eye on the CVD. I hope this video was helpful and valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.